Morning, Mr. Manager, are you ready?
It's like a, well, I thought you're gonna like limbo under that. Go, Sheena. We'll start and make this as quick as we can.
Good morning, Commissioners. Sheena Schmetz, Chief Human Resources Officer. Today we are here to talk about our benefit plan design workshop, and we will try to wrap everything up by 11:15. I know there's some other conflicts that people need to get to. Again, we are here to discuss our 2020 medical plan design. As you recall, on May 8th, the Commission voted to approve United Healthcare as our 2020 health insurance vendor. Now that our vendor is in place, it's time to discuss what our plan options will look like. We did survey employees in 2016 and 2017, and one area of response particular to health insurance was that they wanted a choice of plan design, specifically about cost of premiums and deductibles. Today, we will discuss a few different options that will give employees a choice. Our plan covers approximately 6,200 people, including our employees, spouses, and dependents. These options will be very important to their needs. Sedgwick County has worked with IMA Financial Group to assist us with the medical and prescription RFP, as well as the plan design. They have been instrumental in assisting us to ensuring that we have the best approach for our employees. Matt Cohen and Diane Thornton are here today to lead us through the design. However, I also want to recognize that there are many staff members here today that were part of the RFP committee and have helped us in this process. And with that, I will get this workshop started and turn it over to Matt.
Good morning.
Good morning.
So the goal today is several things. Is really to, one, go through the plan design options, but really to give some education and background to specifically HSAs. Through the surveys, what we kind of found out is that HSAs were an important option for many of the employees. So we wanted to include that as part of the choice. So part of the conversation today is going to be around education on HSAs. I know we have a little bit of shortened time frame, but we definitely want to make sure there's time for questions related to either the plan designs, HSAs, or any other type of kind of healthcare educational questions. Again, as Sheena mentioned, there was a lot of us that worked through the process of not only the RFP, but the plan designs and kind of looking at the choice for the employees and their families. So again, as Sheena mentioned, there's a lot of different things that go on with plan designs, but really the biggest thing that was heard through the surveys was choice. More choices to choose from, and that looks different to everyone. So whether it's a lower deductible with a higher premium or the reverse, a higher deductible with lower premium, it really depends on what your family's situation is, what kind of services you utilize, what stage of life you are, what kind of income level you are. So the process is we really want to give that choice to the employees and their families and not just make the one decision for them. And that's what the voice of the employees has said, is that we really want to make those decisions for ourselves within the scope of what the county can offer. And again, as one of those options, it would be an HSA account. So some of the goals when we're looking at the plan designs, again, is introducing more choice. What you're going to see today is, one, the current option, what does that cost and what does it look like to the county? And then two other options with 3 plan designs in each of those different options. We wanted to keep the traditional PPO as an option. That is what employees and most of the members are used to, but also have that HSA account. The HSA account and the plan that goes along with it are definitely different from what your current plan is and how that operates. So we want to kind of go through that so you guys have an understanding of how that works and how that plan is different than a traditional PPO type plan. A lot of that has to do with the IRS regulations and how that plan has to be set up to have the separate HSA account as well. And then the third goal is really to have these plan designs be within the county's budget. As you know, that's an important part of everything. The one hand, you have the employees and the experience that they have with their plan designs and their benefits. The other side is there is cost to it, and how do we control those costs? Through contributions from the employees, the budget from the county, and the plan design that goes with it and what that's going to cost everyone. So we want to make sure you take that into account as well, not just the co-pays, deductibles, those type of things. So before we go into the plan design itself, I really wanted to do a little bit of education about savings accounts. Currently you have a flexible spending account that goes along with your PPO medical plan. The other option is an HSA account. And while they're similar in their tax handling and savings portions of it, they are quite different in a lot of ways. So I really want to spend some time comparing and letting you know who's eligible for an HSA, how does it work along with the plan design under those IRS regulations I mentioned, and really kind of have that discussion about what that piece is and how does it look from a member's perspective as well. So what you'll see when we go through the plan design itself, we actually have some examples of a few medical costs and how that would impact an employee from going to a doctor, having a hospital visit, maybe a prescription, and what that looks like from a day-to-day benefit examples. So you'll see on this slide here, the HSA is different from the flexible spending account. The ownership of the account itself is actually owned by the employee or the individual. So once there's money in that account, it belongs to that individual or that employee. Where an FSA, it's owned by the employer essentially. The employee can contribute into that FSA account, but ultimately that money comes back to the employer if it's not used. Where the reverse is the opposite, or the reverse happens with the HSA. Essentially, once that money is in the account, whether it's put there from the county, from that individual, from anyone, that money stays with that employee or that individual, whether they're here with the county or they move on to another organization. So who funds that account? It can be really funded by anyone. It can be funded by the county itself. It can be funded by the employee. If you have a grandmother that says, hey, I really like HSAs, I'm going to put some money in there and make sure you're saving for your medical expenses, you can do that as well. Depending on who puts that money in there will determine how the tax savings come in, but it can really be put in there by anyone. With the FSA, it's really the employer or the employee. You can choose as the county to put money in there or not, and then the employee can set aside some money to put in there as well. With these plans, with the HSA specifically, you do have to have a certain type of benefit plan that goes along with it, a high deductible health plan. We'll talk a little bit about what those requirements are in just a little bit. For the FSA, essentially you have to have a ACA qualified plan. That's really the main basics of it. There's no deductible levels or anything like that. You essentially have to have a ACA regulated type plan to have an FSA. The other good thing about HSAs is these funds can be rolled over. Like I said, once that money is in an account, it can be used in 2019 or 2020. Whenever the money's put in, that money continues to build and roll over each year if you have money left in the account. The FSA really cannot roll over except for a couple exceptions. There is a grace period of typically 2.5 months that you can have where you can pay for expenses in the prior year, or you can roll up to $500. That would be the county's choice if you want to do either of those programs. That's really limited to what you can roll over from year to year. The HSA, there's no limit on how much you can roll over. If you have $5 in there, you have $10,000 in there. It rolls over the next year and can continue to move with that account and be used for medical expenses. Again, it is portable, so once the money is in that account, it is the employees or the individuals. So if they move on from the county, then that money stays with them. If they choose to stay on here, again, that money rolls over and can be used for medical expenses. The flexible spending account cannot. So if you were to leave the county and you have money in your account, you essentially forfeit that money at that time. So what can the expenses be used on? Both of them can be used on what's called 1013D, Federal Regulation of Qualified Medical Expenses. What does that mean? It's really qualified medical expenses, including copays, deductibles, or typical expenses. So you have an office visit, you have charge there. It can be used for vision expenses or dental expenses. Really anything that is covered under, doesn't necessarily have to be covered by the medical plan itself, but it does have to fall into this regulation of what type of benefits are covered. There is a list out there under the IRS of complete details, but in general, it's medical, dental, and vision expenses. Under the HSA, you can have some additional things that it would cover: qualified long-term premiums. If you're unemployed, then it can cover your premium or costs while you're unemployed. And then also, if you're Medicare eligible, it can cover the cost of your premiums, except for Medicare supplements. The FSA does not have any of the ability to cover any of the premiums. It's really just those medical expenses. One of the issues with FSAs from a user standpoint is you have to substantiate your claims. So when you go in and you give them your debit card, your card, and you have an expense that's not a typical copay. So say you go to a dentist's office and your charge is $53. You're gonna have to go and back to that FSA company and say, hey, here's my bill, and here's the $53, and it was actually for a medical expense. They're gonna go and reconcile that and make sure you're actually using it for qualified medical expenses. On the HSA, you do not have to do that. It's really on you as the individual owner of that account to make sure they're using for qualified medical expenses. It would not be the county's responsibility to regulate that. It's your job to say, here are the rules, here's your plan document, which you can post or give on request, but essentially from a tax standpoint, that is on that individual to keep record of their own taxes in case they are ever audited by the IRS. And then the last piece of it is do these items in the money in the account, does it have to be spent on medical expenses or can it be reimbursed for non-medical expenses? In the FSA, no, and that's why you have to substantiate it and make sure you're providing receipts or an explanation of benefit. For the HSA, you can essentially spend that money on anything. Once the money is in the account, you can use that money on, hey, I want to go buy a new TV. The issue with that is you would have to then pay income tax on that, and you would also have to pay a 20% penalty. Now, the 20% penalty goes away once you are age 65, you have a death and the money goes to your beneficiary, or you have disability. So essentially at that point, you would just pay it as income tax if you're using it for non-medical expenses. When you think of an HSA, it's similar to like an IRA, an individual retirement account, except for its focus is to be paid for medical expenses. However, just like an IRA, you can take that money out, but you would have to pay the taxes on it, whether income tax or penalty if you're not one of those three categories, 65, after death, or disability. So how do they work? So I told you some of the rules that go along with it, but how do they work? So for an HSA and an FSA, an individual will go and they say, okay, I want to put a certain amount of dollars I want to contribute to this plan every year. It's going to come out of my paycheck, payroll deducted. You would get those tax-free, so you would reduce your payroll by the taxes on that. Once the money is in the account, the money can only be distributed for expenses, except for, as I mentioned, you would have that penalty on top of it if you use it for non-medical expenses, and then that money can roll over year to year. The FSA is, again, you can put money in there. Once you set aside, says, hey, I want to put $1,000 in there, you are set on that $1,000 per year. You cannot change that amount unless you have a qualifying event. On the HSA, you can change that at any time. If you decide at the beginning of the year that you want to have $1,000 in there, something comes up later in the year and your budget changes and you decide, I don't want to have any money taken out of my check anymore, so I want to discontinue to do that, or reverse, and I want to add more money to my HSA account, you can do that. But on the FSA, once you establish the amount you want to contribute, you cannot change that amount unless you have a qualifying event. Qualifying event being marriage, divorce, birth of a child, those type of things. One of the biggest difference is an FSA, once you commit that money, then you can use that money on day one. So again, if you decide you want to put $1,000 in there, on January 2nd, you have a surgery and you want to use that $1,000, you can use that money on day one. Or the HSA is you can only use the money that's in an account. So I like to compare them from a debit card to a credit card. An HSA is like a debit card. You can only use the money that's in your bank account. Or an FSA is like a credit card, and you have your limit, and once you can use that money at any time. and then you ultimately pay back the credit card. So one of the barriers for HSA is that initial first year, because you don't have money built in that account. And as you'll see, some of the way that you pay for actual bills is different. So when you go into January and you have a prescription drug come up, then you would have to pay that money up front, and you may not necessarily have that money in your HSA account established. Or in FSA, you've already set aside that money, and you could use it that first month. Because of the tax regulations on this, there are some guidelines on who can actually sign up for an HSA. You have to be covered by a high deductible health plan, and we'll talk a little bit about what that looks like again in a little bit. You have no other coverage, so you can't be on a spouse's plan. That's a non-high deductible health plan. Your spouse can have other coverage, however, they cannot contribute to your HSA if they have a non-qualified high deductible health plan. If you are enrolled in Medicare, you cannot have an HSA account. If you are on TRICARE, you cannot have an HSA account. Or if you're claimed as a dependent on someone else's taxes, you can't have the account. So essentially, if you have a non-HSA plan, high deductible health plan, then you cannot have the HSA account. So there's two separate parts of it. There is a high deductible health plan, and then there's the HSA. You can be on the high deductible health plan, but you cannot establish the HSA, which is the bank account piece of it, unless you meet the certain qualifications. So as far as the plan design and contribution limits, there are some differences than a typical between a typical PPO traditional plan and HSA. So with an HSA, everything must, a high deductible health plan, everything must go towards the deductible first. Meaning you can't have copays, you can't have an office visit that's $20. Everything's got to go towards your deductible first, except for preventive care. So that's a little bit different than your traditional PPO, where you would go in and you have your $20 copay for your primary care, or you have your $15 copay for your generic drugs. With the HSA high deductible health plan, everything has to go towards that deductible first. There are there are some limits on the minimums deductible and maximum out of pockets. The 2020 guidelines have not come out yet from the IRS, but they typically come out around the end of May, 1st of June, so they should be out relatively soon. A lot of these don't change a whole lot, but they do periodically adjust for cost of living and things like that, inflation of medical cost. So right now in 2019, a minimum deductible is $1,350 for an individual and $2,700 for a family. There's also a maximum out of pocket you can put on that as well, $6,750 for an individual and $13,500 for a family. There's also a limit to what you can contribute to that HSA account. So not only do you have limits on what the plan looks like itself, so you do have limits on what you can put into that separate bank account. So for an individual, it's $3,500, and for a family, it's $7,000. For the purposes of IRS regulations, a family means any group that has more than one person. So it could be an employee and a dependent, an employee and a spouse. It can be just two, or it could be 10. But really, you just have that one additional person to be considered a family for the IRS regulations. If you are age 55 or older, you actually can put an additional $1,000 a year into that account if you so choose. This slide here is really just to kind of reiterate the fact that there are two parts to the HSA, high deductible health plan. There's the plan itself, and then there's the HSA bank account that goes along with it. The high deductible health plan is the benefits itself, so the deductibles, co-insurance, out-of-pocket maximums, that's the plan. With that plan, once you establish that it meets the requirements of the IRS, you can have a separate account, the HSA, that goes along with it to put pre-tax dollars away to use on qualified medical expenses. Right now, what you do is you have a traditional PPO type plan, and that goes along with the flexible spending account. Because it doesn't meet the IRS guidelines of a high deductible health plan, you can't put the HSA with your current type plan. So that's why you have the FSA to put pre-tax dollars away for medical expenses. So that was a quick overview of the high deductible health plan HSA guidelines compared to the current FSA plan. There's a lot of details that go into it and how it interacts from an individual basis. And we'll talk a little bit about that when we get into the plan design options that we're looking at. But this next section is really to look at those plan designs and what it's going to cost to the county and what it's going to cost to the employees. So what we did is the first slide here in this plan design is really taking the current plan as is today, no changes to the plan design. Literally, if you just went from 19 to 2020 on the same benefit plan, what is that cost going to change for the county and what is it going to change for the employees? The way we come up with these numbers is through underwriting and actuarials. Basically, we're taking your current claims, predicting them for the future. That's the simplest way of doing it, but there's a lot of underwriting and actuarial pieces in the background. But the simplest explanation is we're taking your current claims, projecting them forward to the next year to predict on what you're going to have from a claims expense, and then also with the renewal with United Healthcare, what are those fixed costs going to look like as well. We are estimating at this point a 15% increase in stop loss. The stop loss piece is essentially your umbrella coverage that for any claims that are really high cost, it's an added level of reinsurance to cover those claims. Typically those costs are not finalized until late August or September due to they want to determine what's actually going on with the plan and be able to predict those large claims going further. However, I do feel the 15% is a good estimate based off your claims history and current utilization. So it is a small piece of the whole budget, but I think it's a fair estimate on what that stop loss is going to look like. So all that being said, what is the increase of the cost of the plan going to be if we just renewed everything as is? And that's about 10%. So again, that includes the projection of additional costs based off your claims utilization over the last 24 to 36 months. It also factors in the changes in the admin costs from United Healthcare and the stop loss increase as well. But overall, it looks like a 10% increase. From a pure illustration standpoint, we kept the split between the contribution of the employees and the county the way it currently is. Currently, the county pays 95% of the total cost and employees pay 5%. So from this illustration, we kept it at that level. With that, you'll see that the employee costs go up roughly $1.50 a month. However, the county's total cost goes up about $3 million a year when you factor in the current enrollment, while the total cost increase for employees goes up about $80,000 a year. So keeping that level of contribution from the county would increase the current budget by about $3 million to the county and about $80,000 for employees on an annual basis. So that being said, one of our goals was to look at what does a 5% budget increase look like to the county, and wanted to factor that in. It's not the only factor, but it is an important one. So we looked at, like I said earlier, a couple of options. Again, this page is going to illustrate what you're currently paying, the 2019 column. What we just looked at, the 2020 as is, so if there's no changes. Option one is again, 3 plan designs, 2 traditional PPOs, and an HSA option, and then the option 2 is another version of that. Option 2 gets you to the 5% increase for the county, which would be about $1.5 million, versus the current as-is plan, which is a 10% with a $3 million increase to the budget.
And Commissioners, if I could just briefly remind you that in the financial forecast, we said that we planned for a 5% increase in the premium costs to the county for next year. And so this is an option that would be consistent with that The other option that Matt has talked with you about, the as-is or the 7%, would be greater than what we've already talked about, and so that would potentially be another hit to the budget as we go through those discussions about decision packages, compensation, and all those other things competing for that same dollar pool. So that's why this 5% that he talks about is in line with what we've already projected, and that's why it's a strong option for your consideration. So, thank you.
So what do these additional options look like from a plan design standpoint? So this first alternate option, this is the 7% increase to the county. What does it look like from a plan design? What does it look like from an employee experience? And what does it look like from a contribution standpoint? So really the next 3 slides here are really going to go into that. What you'll see on this page is this column here is the current plan. So this is currently the plan that you offer to your employees and their dependents. These are the 3 new options here. So we've labeled them UHC. Again, that's the current insurance carrier. We've called this one Premier. The middle one is called a base plan, and then the high deductible health plan over here on the right. You'll see the highlighted yellow. Highlighted yellow are differences in some of the copays from the current plan. The rest of the copays have and some of the out-of-pockets have stayed the same, other than that top section. So the Premier, we're looking at so let me step back. One of the options from you hear from Choice is, should we pay more premium for a richer plan? And so that way you can budget, you know what's coming out of your paycheck. You have less out-of-pocket when you're actually going to see the doctor or have a hospital stay or have prescriptions. So one of the options is, okay, let's increase the benefits. So let's make them a little richer than they are, but it is going to affect the cost that comes out of your paycheck each month. So that's what this UHC Premier option is. It's a lower deductible, lower out-of-pocket. So instead of having a $1,000 deductible for an individual, it would go down to $500. And then a out-of-pocket. So once you have your co-insurance, you would pay up to an additional $500 and get to that $1,000 out-of-pocket maximum. The base plan option is very similar to what you have today. Again, without other than the highlighted pieces down there. So the emergency room copay would go up a little bit. The prescription copays would go up a little bit, except for the generic. The generic would actually go down $5. Again, trying to drive people to those lower cost medications that can have the same effect as a brand name drug, but at a lower cost. So really just trying to drive them that way. And then the last option is the high deductible health plan that is qualified for an HSA. The biggest difference on this plan is you would have a $2,700 deductible. And as I mentioned earlier, everything has got to go towards that deductible first, except for preventive care. So that's going to be quite a bit of a change for someone that is used to paying a copay at the doctor or prescriptions on a monthly basis, that has that higher deductible and know that none of those copays would apply to it. The good news is we've set it up where the $2,700 is your maximum for the year. So once you have that $2,700 deductible, your coinsurance is 100%. So the employee would pay $0 after that. So your wage
For a single.
for a single, yes. For a family, it's $5,400. That can be met by one individual meeting $2,700, second individual meeting $2,700, or if you have a family of 5, any kind of combination to get to that $5,400. But no one person can pay more than that $2,700 on that plan. Again, the biggest hit to individuals is when they move to an HSA, high deductible health plan, is kind of the budgeting from a pharmacy and a doctor's office visit. Those are the ones that hit the most. Those you're used to having, an office visit. What you do get under this plan is you still get the discounted rate from United Healthcare. So you're not paying street costs. You are getting the contracted rate that United Healthcare has with their network, assuming you go in network. However, for an example, I'll show you some examples here on the next page. Here's what some 3 basic examples of types of services and what they would cost to an individual if they were to happen. So scenario 1 is just a basic sick office visit and an antibiotic that's prescribed. So under your current plan, you'd have a $20 copay for the office visit, $15 copay for the generic antibiotic. Total cost for that visit is $35. Pretty manageable from a budget standpoint. Everyone's used to that because that's what it is today. Both the Premier and Base plan, we're not changing the copays on those, so you're going to have that same out-of-pocket expense there as well. For the high deductible health plan, it works a little bit different. So you're going to pay the cost of that actual office visit. So retail street prices are going to be, say, $100 for or $120 for an office visit if you just went to the doctor's office and had no insurance coverage. Because you have United Healthcare as their contracted rates, you're going to get what they would pay to United Healthcare, which is $80. And again, these are on average. These are not everyone. They do vary by provider, but this is an average cost of just an office visit. So that person's going to pay $80 instead of that $20 copay. They're also going to pay the cost of the prescription. Again, they're going to have the network discount, but they're going to pay that cost of that antibiotic. So it's going to be more than just the copay, typically. So in this scenario, instead of paying $35 for that office visit and an antibiotic, it's going to be $97. So it's a little bit different than just you used to have your copay. You know what you're gonna pay. You're gonna pay that actual price from the contract from the United Healthcare network.
Plus what I pay every month out of my paycheck.
Yes, this is.
So what do I pay out of my paycheck?
So that'll be the next slide of
Okay.
what it is. But yes.
So why would someone do that? I mean, if you're relatively healthy,
Mm-hmm.
why would you do that if you? Can you help me understand that?
Yeah.
Okay.
So typically, and we'll see on the next page, that these are lower cost from a contribution standpoint out of your paycheck cost. So a lot of people, again, it goes to the choice. Some people want to pay, I want to pay a premium essentially for a lower deductible. I know what's going to happen out of pocket, but I'm going to pay a higher cost out of my paycheck. So I have that security of knowing what that cost is going to be if something does happen. Some people would say, I don't want to pay the premium. I never go to the doctor. I don't want to pay extra money because that's more to my paycheck. I want to take the risk of saying, I'm going to pay a lower premium. If something does happen, I still have protection, but I don't want to waste the money, but I never go to the doctor, so I don't want to spend that extra money out of my paycheck. So this really gives 3 levels to choose from. There's the richer plan that, it's going to be a higher cost out of your paycheck, but you know if something does happen, this is going to be my maximum exposure. There's a middle plan that's a little bit in between the two. It's a lower premium than the rich plan, but it's not as low as the high deductible health plan. And then you're going to have the third option, the high deductible health plan, which is a lower cost out of my paycheck, and hopefully something does, nothing major happens, and I don't have to spend that money in premium. However, if something does happen, then I know as an individual, the worst thing's going to happen is $2,700.
The rich plan is the premier plan?
Yes.
Okay.
Mm-hmm. So the scenario 2 is hospital stay. And we're going to assume that the total charges on this one are going to be $10,000. So this would be the total allowed amount, meaning not what they billed, not the total amount that's allowed under the contract. From the current plan, you'd have a $1,000 deductible, and then you would pay an additional 20% up to another $1,000. So it'd be $2,000 out of pocket on this $10,000 bill. The Premier plan would be $1,000. So you'd have a $500 deductible, and then you'd pay 20% up to the next $500. So you're out of pocket on that one's $1,000, so $1,000 less. On the base plan, which is similar to your current, it's going to be, again, a $1,000 deductible. You'd pay the 20% coinsurance up to another $1,000. And in this case, your worst case scenario for that stay would be $2,000. Now the high deductible health plan, that same $10,000 bill, you're going to have a $2,700 deductible, but no coinsurance after. And so instead of having a $2,000 out of pocket like you would on the current plan, it's going to be $2,700. So really the difference on we'll call it worst case scenario, is $700 for that hospital stay. That being said, once that $2,700 is met, you are done for the year. So if it happens in January and then something else happens in, say, June, you don't have to pay another $2,700 deductible because you've already met your deductible and you're out of pocket for the year. So everything would be covered by the plan at that point at 100%. And then scenario 3, this is for a high cost brand medication. Currently, you have 3 tiers of prescription copays. We're assuming this is on the highest tier. Right now, on a monthly basis, if you had that prescription every month, we're assuming it costs $5,000 per month. And I use the high cost medication just for the experience of what might happen to someone that does see a high cost claim. But the same happens from a lower cost as well. But I will tell you that high cost medications are more and more common. $5,000 per month medication is pretty regular at this point, and some are much higher than that. So it's really to illustrate the point that if this happens in January, it may be a tougher pill to swallow, no pun intended, for someone that has this high deductible health plan versus someone that has a copay each month that they can pay for their prescriptions. So in this $5,000 a month prescription, on the current plan, it's going to be $55 copay each month. So if you had it every month for 12 months, it's going to be $660 for this prescription. Under the Premier plan, we did actually raise the copays on the higher cost drugs, but lowered them on the generics. So it's going to be $70 for a high cost medication. Once a month for 12 months, $840. Same prescription plan on the base plan, so those are actually the same for this tier. Again, it's $840. On the high deductible health plan, the member is going to pay that $2,700 deductible on month 1. So if they have it in January, they're going to have to pay $2,700 for this medication. Once January is done, they don't have to pay for each month because you've already met your out-of-pocket maximum. But again, that first month is really tough for someone that's used to paying $55 for a copay. Now they owe $2,700 in January 1st, or in the month of January. So one of the questions you asked was, why would anyone take this? If someone knows that they're taking a $5,000 medication, this might not be the option for them, knowing that they're going to have to pay $2,700 in January for that medication. Now, with United Healthcare, it hasn't been as important in the past because of the copays and some of the deductibles, but they do have tools that you can go online and actually look up your medications or look up the cost of an MRI or certain procedures online to actually understand what that cost is going to be. So one, it can help you plan to decide, is an HSA the right plan for me? But it also helps you out through the year if something comes unexpected and I need an MRI to look at my knee. Well, you can go to the hospital and it's $2,500, or you can go to a freestanding facility and it's $400 or $500. So it makes someone become more of a consumer because they're using their own money, and in turn helps the plan because you're looking for those low cost alternatives that still do the job, and you still get the benefit of the services. However, it's a more appropriately cost service than having a test done in the hospital that doesn't need to be done in the hospital. It's a different mindset for sure. You have to ask more questions of the doctor. You have to be proactive. You know, sometimes the doctors will just say, hey, let's just go down the street to Wesley or Via Christi and get the MRI done. You have to take a step back and say, okay, I do need to get the MRI, but I can go over to a diagnostic imaging center down the street and it's going to cost me 3 times less. So you do have to ask those questions. Same thing on a prescription. They prescribe a brand name medication, and you have to ask, are there alternatives? There are some mechanisms in place, again, with online features to help the members actually do some of that research. Most times the doctors are willing to help on that, but you do have to ask the question sometimes. You know, they're set in their ways too, and they hey, this is my go-to medication, so I'm going to prescribe this one. Sometimes you have to ask, what is that going to cost me, and is there an alternative? So what is this going to cost? Again, this is what we're looking at on this page. Is the left side is the current premium. The right side is the projections based off of the new plan designs. Some of the key points on this side here is the employee spend. So I mentioned earlier that currently you're at a 95% split between the two. So the county pays 95%, the employees pay 5%. to make this, you have to split it up so that there is a spread between the different plans. Otherwise, everyone's going to get the richest plan if they're the same cost. So you have to differentiate between the cost of the plan. What you'll see here is currently an employee is paying $26.70. On the Premier plan, it would go up to $74.76. So again, this goes to someone that wants to budget more easily, and so they want that money to come out of their paycheck versus having a higher deductible if something were to happen. But it is quite a bit of an increase. So you're looking at almost $50 out of their paycheck each month, and that's just for the employee. The family goes up even more, from $77 to almost $217 a month. So again, it's quite a bit of an increase from a family perspective. So that might not be the right option for that particular family because of the deductions out of their payroll. So the middle plan, which is most like the current plan here, so looking at this section here, the contribution goes up from $26.70 from an employee to $37.38 for an employee. Family goes up from $77.43 to $108.40. There are a couple factors here. One, we talked about the cost of the plan going up about 10% this year. That's a piece of it. We did also increase the portion that the employees would pay from a contribution standpoint. So instead of being a 95-5 split, it would be a 94-6 split. So they'd pay 1 additional % of the cost of the plan. And then the bottom section, here's the high deductible health plan. So here's one of the reasons that someone would choose a high deductible health plan. The cost for an employee would be $13.35 versus the $26 they're paying now was $27. The family would go down almost $40 from $77 to $38, almost $39. So again, you're having that reduced cost out of your paycheck. The hope is it would give people the difference to put that money into the HSA account and put that money in for medical expenses, where you get pre-tax dollars and you can save some of the tax expenses on that. However, they have that option of not putting any money in there or putting is up to that limit of $3,500 for an individual or $7,000 for a family. The hope is that people do actually put money in there and aren't just taking the lowest cost plan. But again, that's their choice, and the point of these is having that choice. This last column is if the county were to put money into an HSA account for the employees and their families. So we talked about that first month being tough, especially for prescriptions or different costs on office visits. This is an example, the rate we calculated was $50 a month, $600 a year, or $100 a month, or $1,200 a year for a family. $600 for an individual, $1,200 for a family. That would cost about, essentially what we're assuming on this is about 10% of the population would go into the high deductible health plan. If 10% did, roughly it would cost about $246,000 annually to put money into that account. However, it does give the population an option to kind of get started on the HSA high deductible health plan and not just going into having no expenses paid. We're having that $2,700 prescription charge. We're having the almost $100 in offices that we're not used to. So it gives them money to have set aside already by the county to get them started in that plan. So we also looked at another option. This option gets us to the 5% that was budgeted for the increase, but does have some differences in the plan. So instead of having, again, right now we have that $1,000 deductible plan. We essentially gotten rid of that plan and created two separate options that are similar in some copays, but the deductibles and out-of-pocket are different on a lot of these. The Premier plan on this option would be $750 for deductible for an individual and $1,500 for family. The out-of-pocket would be $1,500 for an individual and $3,000 for a family. So it is lower than what, or richer than what it is today, but not quite as rich as that $500 option from the previous example. The base plan, so the middle plan, instead of having a $1,000 deductible, will go to $1,250 for an individual and $2,500 for a family. The $2,500 or the out-of-pocket maximum will go up to $2,500 and $5,000 for a family. So a little bit of an increase there. And then this high deductible health plan option, again, it's the same one we looked at before, a $2,700 deductible for an individual and then 100% coverage after that. So this option, one, gets us closer to the budget, or gets us to the budget, but also one thing it does is if you were to keep just a $1,000 plan option, the majority of the people are not going to consciously make a change. They're just going to renew with the current plan. They're just say, yep, that's what I've done and I'm going to keep doing it. What this does is actually makes people conscientiously think about their decision on what plan makes sense for their family. So while you're giving them the choice, it actually helps them make the choice. It doesn't tell them which one to pick, but it forces them to actually have to choose. Again, so some of the same scenarios. A lot of this doesn't change from the previous one. The scenario one is exactly the same. We didn't change the copays. The high deductible health plan is the same. So this is slide 16. Again, $35 from each of the traditional plans, and then $97 for the high deductible health plan. Hospital stay does change a little bit. So we obviously changed the deductible and out of pocket. So the current plan, you had a hospital stay of $10,000. What does that look like to an employee? It'd be $1,000 deductible and then another $1,000 in their co-insurance. Total out of pocket for that $10,000 visit is going to be $2,000. That's the current plan. Premier plan, $750 deductible, $750 in co-insurance. Total out of pocket, total cost for this $10,000 stay is $1,500. So again, better than it was before, just not quite as rich as the previous option. Base plan is a $1,250 deductible, $1,250 co-insurance. Total out of pocket, total cost is $2,500. And then again, the high deductible health plan, $2,700 deductible, no co-insurance. Your total cost is $2,700. And then the prescription copays were the same as the previous option, so those didn't change from a couple slides ago. But it's $660 for the current plan, $840 for the Premier, $840 for the base, and again that $2,700. Assuming it happens in January, then it would be all in the first month. So what does that look like from a contribution standpoint? They're a little more reasonable increases to the employees and their families from the previous option, again, because of the lower cost and not as rich deductible options and out of pocket. So this top section here, that would be the Premier plan with $750 deductible. You're going to go from $26.70 per month to $69.42 for an employee. Family jumps from $77 to $201. So again, quite a bit of difference there. However, you do get that richer coverage, as we mentioned before. The base option, or that $1,250 deductible, you go from $26.70 to $37.11 as an employee, and as a family, you go from $77.43 to $107.63. And then the bottom option, the high deductible health plan. Again, you're decreasing almost in half, so $26.70 to $13.35 as an employee, $77.43 as a family to $38.72. So, again, the decisions are: one, do we want to offer choice, has been what the surveys kind of suggested, that's what the employees want. And then which one of those choices do we look at? So with that, I'll open up to questions.
We got questions?
Yeah.
Probably.
Lindsay, so the last option alternate option 2 fits in what you've budgeted for 2020.
Right, the financial forecast calls for a 5% increase
Right.
per year, and so this would be the only option you've seen today that would not add to that projected deficit
Right.
that you saw.
Option 2.
Yeah. Page 17, basically. Well, I think they all, everybody knows their premiums go up slightly. I guess on option 2, looks like there's the 3 options that employees can choose from to stay close or go up or even go down. Trying to summarize your 45 minutes in 10 seconds.
Yes, essentially the would give you a chance to make that choice of, do I want to pay less out of my paycheck and potentially more from a hospital visit or any type of medical service, or do I want to do the reverse and pay less out of my pocket and potentially have less from an out-of-pocket standpoint from a hospital service or medical service.
So, but from the under the option 2, the annual cost for employees on all these scenarios would be that $2,398,000 estimated.
$2,398,000.
EE, one thing right there.
Oh yes,
Yeah.
yes, correct. Sorry.
So the employees would pay almost 2.4 million, and the county would pay 32+ million.
Yes, correct. Now, the one thing with that's the budgeted amount essentially.
Right.
If claims are different, then it could change, but that would
That-
be
If the claims are different, does that affect the next year? Is that how that works?
yeah. So from a
Doesn't really
Lindsay can
change
answer
during
more
the
of
year. Doesn't change during the year. It's stuck for this year, 2020, and then we're looking at a 3 or 5 year agreement that renews or reviewed every
So
year.
we're self-funded, so we can do whatever we want from year to year, but yes, from our perspective, it would be up to the commission to tell us if you want to draw down, use some of the fund balance in the fund to subsidize, to maybe mitigate some of the impact. If we had a bad claims year, then yes, the following year, we'd have to make a decision about if we shift some of that to employees. Does the county bear it all, or how does that look?
Good point. Thank you. Thanks.
Commissioner Howell?
Just for clarity, this has nothing to do with dental or vision, correct?
correct.
And on this, do we have similar benefits in terms of, say, chiropractic is the same for various plans? In terms of it's eligible for HSA funds or either the PPO plan.
Yes, the chiropractic would stay the same as it currently is. So it didn't change any benefits.
So that type of thing, there's no significant differences in terms of the types of claims that might be made under any of the plans. They're all the same as we have right now.
Yeah, the biggest difference is the out-of-pocket share, not what's covered and what is covered.
Well, anyway, just because my wife typically pays more attention to this than I do, can you please remind me what our current plan is? What's our say for single and family, our deductible, annual deductible, and our copay, I believe, is once you've hit the deductible, it's an 80-20 split. Could you at least confirm that? What's the current deductible amount for single and family right now?
Sure. So it's listed out
Which
here.
page is that on?
Yeah, I just switched it back on the screen, but it's page 15, and there's a couple other pages as well. But right now, it's a $1,000 deductible for an individual, and then at that point, you would pay a 20% coinsurance up
Okay.
to a $2,000 maximum on that piece.
And that's all out of pocket for the employee. And then, of course, each, to get that plan is a monthly cost or a per paycheck cost. What is that on here somewhere?
Not the per paycheck, no. Just a monthly cost.
So what I'd like to find out from my perspective is what's the employee actually putting out before on an individual or a family basis? What's their actual out-of-pocket, including their monthly premiums, monthly cost to the employee? It says it's 5%. We cover 95%, but the 5% that is the employees right now, if that's the right number, is there a dollar value? Is it 5% of their paycheck, or is it
No.
it's a cost per employee? It's dollars per employee. Okay.
Should be $320.40 out of their pocket per year, plus their deductible and coinsurance, for a total of $2,000. So $2,320.
Okay, so that's for single?
That's correct.
A single. It'd be double that for family.
Not necessarily.
Okay.
For a family is $929.16 for their premium payment. And then a $2,000 deductible, $2,000 co-insurance.
Okay. And of course, any one member of that family would be $1,000 deductible and $1,000 for the maximum out of pocket. But if there's other family members, it would get you. I was probably saying that right, but any one member of the family, it's $1,000 and $1,000 for the deductible and the maximum out of pocket per year for a single member of that family.
That's
Correct?
correct.
Okay. But if they have multiple members having claims and stuff, it could be as high as these numbers here. So it could be essentially about $5,000 a year. That's what I'm trying to get to. The reason I bring that up is that for my family, I mean, some of us in our family do go to the doctor more than others, but $5,000 for the employee to get to that 100% is a fairly significant thing. On the high deductible health plan, if I understand correctly, based on option 1 and 2, the employee's putting out, I'm going to find it here, for the employee, $1,335 a month. That's monthly, so it's
Monthly
only half
for-
that for each paycheck.
Correct.
And then for a family, it's $38.72.
Yes.
And now, are we as the employer, are we putting money into the HSA for them at all? Or is this?
We are opting to put $100 in for family and $50 for an individual.
So
On a monthly
Or
basis.
$600 per year or $1,200 per year.
okay. So I also notice on here that the county's monthly rate is currently $507, and under that plan goes to, again for the single, it's $507, and it goes to $562.
So it would be $512. $562 is if you include that $50.
Oh, $512.
Mm-hmm. Correct.
So for the county's cost isn't going up much, from $507 to $512.
On that particular plan, correct.
And under the other plans, what's it going up for the county? Other plans right now is $507, and for the county it goes up to, I see $532.
Yes.
Well, that certainly isn't a 5% increase to us. That's a pretty small increase for us.
Yeah, part of that is we're increasing the portion that the employees pay as well on 2 of those options from a
Right.
percentage standpoint. So that offsets it a little bit.
Well, for the HSA to work, there's got to get money put into the HSA for this to work. And I'm trying to find a way for it to get, I mean, right now, before I see a benefit from my insurance, we've got to hit at least the deductible before I see any benefit, correct? Except for well checks. Well checks are covered.
Correct.
But outside of well checks, we have to hit the deductible before we actually get to enjoy any benefit of our insurance. So that's
Correct.
about $1,000 a year. On top of that, I'm paying, a monthly fee of whatever it was you told me a minute ago, $350 or so per year total, whatever the number was. And so it's going to cost me about $1,300 before I see any type of benefit whatsoever as a single person. It'd be nice for some of that similar money to be going into an HSA, so you build up the balance in the HSA. So when you do have claims, you've got an account to pay those claims. That's the whole point of the HSA. If everything's actually out of pocket and there's no money sitting in the HSA, it doesn't get to be, you don't feel real good about that. You've got to have some money in there.
Mm-hmm.
Money we put in there, if that's $600, that's for us, that's non-tax funds, and I mean, there's no taxes on that. It's just a cash benefit. The employee puts in any money in there, it's tax deferred.
Mm-hmm. Yes.
Okay. And that money in that account also bears interest, correct? Compounding interest?
So it does. It does get interest. Interest is very small. Typically, it's less than 1%. However, there are certain levels of money that's in the account where you can start investing in, typically in mutual funds. If you choose, you don't have to. You can take your 0.5% of interest and collect on that. But a lot of people will invest in some mutual fund type.
Is the money in the HSA transferable? I mean, you own it, so you can. I understand it's transferable. As one of the benefits of having an HSA is if you need to transfer it to some like a different family member that's outside your plan, you could do that as long as the money stays in a medical.
So yeah, there's lots of rules on the transfer. Typically, if you're transferring it to just another family member, if it's in your immediate family, then yes, you can pay for medical expenses. If you're just, I want to take $2,000 and give it to my aunt because she needs some help, no, you can't do that.
You can't do that.
Well, I guess let me correct that. You can, but then there's some tax penalties for it.
Okay. So I thought that was one of the benefits is that was
Yeah,
more transferable.
Yeah, you can take the money out and transfer it, but they're potentially, depending on what kind of account you transfer it to, there could be some tax penalties.
One of the things that's interesting about an FSA, if I understand correctly, is you say the money's available on day one.
Mm-hmm.
So you say I'm going to put, let's say, $2,000 in my HSA or my FSA,
Mm-hmm.
and then they divide that out. So each paycheck you pay for 1/26 of that each paycheck, but that money's available on day one. If you are terminated for whatever reason, quit or whatever happens, that money is not paid back.
Correct. Yeah, it is a liability for the county.
Yeah. Is there any rules about someone who's planning a retirement that they would do that intentionally? I don't know if that's something that's we ever watch for that. There's things that are allowed under FSAs, for example, maybe LASIK surgery, for example. I don't know if that's allowed. I think it is. But I see someone plans an expenditure, and they say I want to put a couple $1,000 in my FSA, and I'm going to retire in March. Could they do that?
Yes.
Okay. Not saying that it happens, but it's something that ought to be aware of. And on the FSA, there's no interest on that at all. There's no
Correct.
interest. Okay. And of course, if you don't lose it, if you don't use it, you lose it. The comment about you cannot be claimed as a dependent on someone else's tax return, that's only for our employees. They can't be claimed on someone else's tax return that are a part of this plan. If they're doing a joint return, their spouses are going to be claimed as a married couple, for example.
Yeah, if you're filing together or married filing jointly, those type of things, you can do that. It's typically what you're looking at is someone who's 25 and has their own account, but still getting tax deductions from their parents, type of deal, or someone that's disabled. You can't. You just can't be filed by someone outside of your family on it. If it's your family unit that's filing a taxes, married couple, and you're filing together or separately, you can do that. It's just you can't be claimed by somebody else and get a tax break that way.
Is an employee allowed to pick something outside the United Healthcare high deductible health plan as a qualifying HSA insurance plan? It could be outside of what United Healthcare provides. Could it be Atlas MD, for example?
Do you mean like a separate plan, or?
In other words, if I don't really want to do United Healthcare, because I think it's not the plan I want.
Mm-hmm.
Am I allowed to pick something outside? Still have an HSA and have the employer and myself put money into it and buy an outside plan. You guys have to offer one, it sounds like, to make this possible. But if I don't want to choose that, could I not go outside the county and pick something like Atlas MD, for example?
I understand that one particularly doesn't offer a benefit plan, but say they wanted to go and get a Aetna plan or whatever,
Okay.
whatever the other. No, the answer is no. At that point they can. It's not an IRS regulation that says you can't do that. You can give them money, but you can't. The county is not set up to have some going else and get their individual.
Okay. So the only HDHP plan we're going to offer them for them to get an HSA would be this one option.
Correct.
Are we potentially offering them options 1 and 2, or just one of the 2 options? You have the option 1 or 2. We're not doing.
Correct. It'd be one
It's
or
one of
two.
our decisions we have to make today is which one of the options we're going to pick, if either one. Okay. I don't have any other questions for a few minutes. I may
you.
have some more.
Commissioner O'Donnell?
Thank you. And thank you for all this. IMA's obviously done a fantastic job of compiling all this information for us. So really what it comes down to for us is we have to decide which one we want to go with. Is that correct?
Correct.
So then from there the employees can figure out what they want to do. But we need to decide if we want to go with this pretty much the base or the premium.
No, so you would be picking from, as I have listed them here, alternate option 1 or alternate option 2.
Right.
Within each of those options, there's 3 plans. At that point, it's the employee's choice to pick from those 3 plans. You're just selecting which 3 plans to offer, and then they make that choice.
Right.
Okay.
And I think I misspoke, yeah, but just the 2 options. And then my other question was the other things we talked about, like plans for gym membership and stuff. Is that a separate discussion that we figured this out and then we're going to discuss that? Okay. Well, that is what I was wondering. So, nope, thank you. This is great.
Thank you. Commissioner Cruz?
So on option 2 for a family, if you pay the family the $1,250 deductible, is that per person or is that per family?
The deductible?
Yeah.
So it's $1,250 for an individual or $2,500 for family.
Okay.
So one person won't pay more than the $1,250.
Okay.
But also any combination of the family won't pay more than the $2,500.
$2,500. Okay. And then, just for clarity, this $107 for a family would be split amongst each paycheck.
Mm-hmm.
Yeah. Okay. So each
The 107 is per month.
per month. Okay. That's it. Thank you.
Okay. Let me get back to real basic before we start, okay? Well, you started off this briefing saying that the reason we're doing this is to provide flexibility. If we did not give flexibility, is there a cost to us doing this flexibility?
From an administration standpoint,
No,
or
total
from a
cost
budget?
to the county. Yeah. If we stay with the plan we have now and don't offer flexibility, there's cost savings.
It's actually going to cost you more if you don't offer the additional plans.
Okay, well, that's what I was trying to find out.
Okay.
Is, we've talked about it several times, but I've never. I want to be sure that I understand the reason we're going this direction.
So-
Yeah, part of what we're looking at is, one, the flexibility to respond to what the employees were looking for, but also the second piece is make sure that it's budgeted appropriately. And so when we're looking at plan designs, factor that in as well. We could offer really rich plan designs and make it, the flexibility cost more, but that was part of the process of, one, let's make it flexible, but also two, be within the budget.
Okay, so we get 2 benefits. We get flexibility to our employees to choose, and there is a cost savings to the county totally.
So Chairman, if we just left everything as is, that cost would have been 10%, which would have been 5% greater than what we had forecasted, and would have been another $1 million in the tax funds of costs for just the county's premium. And so page 11 kind of does a nice job of kind of a synopsis. So 2019's total is listed, 2020 as is listed, and then as you go across on the county portion in the middle, you can see kind of those cost fluctuations. But this is, you're right, this does 2 things very well and keeps us within budget.
Very good. Well, between our health folks and our HR folks, you're our experts. The 5 of us sitting up here are far from the experts of what we're talking about today. So
All we need you to say today is stay in the budget or we're outside of the budget and provide a richer plan.
okay. Well, I want to stay within the budget.
That's all we need.
I would
I
agree.
think that all of our commissioners agree that we need to stay within the budget. Do you need anything beyond that then? Okay. And which one of these plans we choose, are you all going to make a recommendation to us? Or do we make the choice, or are you making the choice?
Our recommendation is option 2, staying within 5% of the budget.
Okay.
With the 3 plans within that option.
Very good. All right. Commissioner Howell has a question.
Just a summary here. I actually like option 2, but from the employee's perspective who want to stay status quo, to them it's $250 more per year for the deductible. and it's $10 more per month or $5 more per paycheck, roughly, for them to be in that plan. So if they want to stay with what they had before, to them, they're going to see about a $5 more per paycheck going out for their premium and $250 more per year in their deductibles. Want to make sure that's understood. But I would support option 2. Thank you.
Very good. All right, commissioners, what else you have on questions?
Sounds good. Thank you, staff and support staff and IMA. Appreciate it.
All right, Mr. Manager, you have anything else?
Thank you.
Hey, Sheena, you have anything else?
Thank you.
All right. Well, thanks for
Thank
coming and brief us on that. We appreciate it very much.
Thank you.
Thank you.
Perfect. Okay.